Okay, well, thank you so much for having me here today, and glad everybody's here. So hopefully you'll learn something about, the way I like to look at trading the markets based on direction and options. So this presentation is selling options for income, profits, and opportunistic hedging. So we're going to look at a 6-step plan for option trading success. So we're going to look at step 1, the secret to trading profits using options. 2, how to maximize your option profits. 3, selecting the right directional option strategy. 4, how to trade time. And 5, directional option trade review. And then how do you bring it all together so you can start using it in your own trading. So, I've been trading back since 1980 and started out trading with a large oil trading company and went on to run the International Trading Group for one of the largest oil trading companies in the world. And really trading for us came down to direction and then managing our trading risk. And so, that's been an important part of my trading ever since. And so the way to do this is using options, in my opinion. So the following webinar here tonight is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So step 1 is, the secret to trading profits using options. Now, let me get my slide to forward here. Now, option trading has so many more advantages than just trading outright stocks, but as you probably maybe already know, it can be a bit more complicated as well. But once you understand the benefits and advantages of option spreads, you're never going to really look back. So the key to swing trading profits, and those are trades that last more than a day or longer, is to use and incorporate option spreads for controlling your risk. And why? Well, because the unique pricing structure and capabilities that the option spread offer you, you can control the probabilities. And the probabilities that can be then tilted way in your favor if you know the correct spreads to use. So when used correctly, option spreads are going to help you to really keep your capital at risk low. It's going to help you to define your maximum risk, and options provide you fantastic leverage. So step 2 then is, well, how do you maximize your option trading profits? And it really comes down to knowing how option pricing works. So the major component for option pricing, the first major component and the most important one in my opinion is time. Now, when trading options, the most important option factor really comes down to understanding the concept of time and the impact that it does have on the price of your option. Now, time value is also what we refer to as the extrinsic value of an option. So it's going to be the premium that a rational investor is going to be willing to pay over its current exercise value, the intrinsic value. And this is based on its potential then to increase in its value before expiring. Now, this probability is going to always be greater than 0, thus an option is always going to be worth more than its current exercise value. And the change in the value of the option based on time decay, we can actually measure that using the Greek theta. So that's another great thing with options. We have these theoretical Greeks that we can use to measure certain aspects of price. So what are the characteristics of theta or time decay? So when you look at option theta values, they're going to either be a positive value or a negative value. So all long stock options, such as if you're long a call or long a put, those will have negative theta values. And that's going to indicate that they're going to actually lose value each and every day as expiration draws near if the price is not going anywhere. So if it's a stagnant, churning price, they lose value each day, so it's negative. Now, all short stock options, such as if you're short a call or short a put, that has a positive theta value, which indicates if price goes nowhere, that those positions are actually going to gain in value as expiration draws near. So it's a really important component, and it's an important thing or dynamic to understand in options, how that time decay can affect your option and actually then be put to an advantage for your trading. So it comes down to the price of the option, and that really comes down to these components. So the first one will be time value, and then times the implied volatility, then times your underlying value, the intrinsic extrinsic value. And once you know these variables, then you're going to be ready to price an option, know what its price should be, and then have a better idea of what option strategies that you should use. So here's a simple table to kind of illustrate how these components affect price. So we'll start out here, and if you look at this table, This is based on a weekly option series. So every Thursday, we'll get a new option series that comes out. And most all the options now will have weekly options. So it's a really great way to incorporate these weeklies to your trading. There's so many things you can do with them. But that first day you'll notice here you'll have a 100% time component. That will be 100% of that option price that first day. And so then the time value times the implied volatility of the underlying of that option times the underlying value, the intrinsic extrinsic creates the underlying value. And I'm going to keep this at 1 so you can see how these pricing components flow through, and that equals the premium of the option. Now there are other elements to this. You've got gamma and stuff like that, but these are the main components. So if you look here Thursday, you can see that you've got 100% time in there times the implied volatility. We put it 300 times the underlying value, so that puts your price of this option day 1 at $300. Now you'll notice then on Monday that time value component or portion is cut in half. So even if you increase the implied volatility in this example up to 800, you can see that the price of the option barely went up. And the other big takeaway here is you can see that time value and implied volatility are going to 0 at expiration. So these are two components that don't want to lose track of, because they're going to be at 0 value at expiration. So it's a great way to then incorporate this into your trading, and one of the best ways to do that is through selling option strategies. So step 3 then is to select the right option strategy. And one major goal of every trader, in my opinion, really should be to select trades that are based on what's going to provide you the most consistent return with low defined risk and not always that greatest return. So I'm not looking for home runs in the trading. I'm looking for singles, doubles, triples, and occasionally you're going to get that big hit, but you want to be very consistent and have a really smooth equity curve. It'll make your life a lot easier, and it'll keep you in the game a lot longer. Now, to do this, it really comes down to knowing then the best low-risk option strategies that are out there and available, how they work, and then selecting the one that's best suited for the market environment you're trading in. And everybody here tonight, has a different amount of capital that you can trade, so that's going to really be a big factor in, your risk profile. So Richard might have 100,000 in his account that he's trading, and Sam might only have 10,000. So it's going to make a big difference. Now here are some of the strategies that I like, and these are once you get the foundation down, they're very simplistic to understand. And so these are directional low risk option strategies. So the first one is just to incorporate selling an option credit spread. So selling options, and by doing it as a spread, you're going to cap your risk. And I'll show you as we go forward how that works. The next one that I really like, I've kind of termed this one the ninja credit spread. So it's basically comes down to being a ratio butterfly, but it adds an additional credit spread into a butterfly, and it really presents a fantastic structure that's very, very low risk, but has a great return on your capital at risk. And then the third way to take advantage of selling options is for hedging. So out of all the different strategies that I've looked at over the years of trading, the best go-to way to neutralize a trade and to hedge a trade is to incorporate selling strategies into your option trading, or into your trading in general. And if you think about options, they were originally created for hedging, so that's the key element that they were designed for. So a lot of people lose track of that and look at it only for speculative gains, but really you should start using more option strategies into your hedging as well. So when you're selling options and option credit spreads, why would you look to do this strategy? Well, once you get down into the nitty-gritty of it, you're going to look and see that they can really work regardless of market direction. You don't have to be exactly right on the timing aspect of it, or exactly right on the price. And they can work even if you're wrong, which is pretty amazing. Now, the winning probability of profit when you're selling an option 1 standard deviation out of the money is also, you're going to start that trade out then with an 80% probability of that being a winning trade, even without adding technical analysis. So then let's think about it. If you have a trading model or system that you're using that's more accurate than 50-50, then that just increases those odds even more. So statistically, if you start out with a trade statistically that has an 80% chance of winning, you add a decent trading model to it or system, you can then increase your odds even greater. And the main thing too is incorporating selling option strategies are perfect for hedging to take advantage again of that time decay element. So step 4 then is, how do you trade time and take advantage of time into your option trading? And that's done by selling options or selling option credit spreads. Now there are 3 types of credit spreads, and you're going to have the bear call credit spread, and that's going to be a bearish strategy. You're going to have a bull put credit spread is a bullish strategy, and you're going to have the long iron condor. So let's take a look at these various strategies of incorporating selling options. So the first one is a bear call credit spread. So it's going to be best used if you think the market's going to go down. Now you could just sell, out of the money or sell options or calls by themselves naked, and you could accomplish the same thing and actually get greater returns. But the problem with this is that you're going to have a portfolio margin account, which a lot of people are not going to be able to get. And the other thing is they have a lot of risk if you're not really familiar with how it works. So it's really better, and what I usually just look at doing is incorporating or using the bear call credit spread. So it's basically you're selling one call, but you're also then with a lower strike, but you're also simultaneously going to be buying another call with a higher strike, and these are in the same month. So it offsets your risk, or it caps your risk. So let's take a look at an example here. So this is an example of a bear call credit spread. So in this slide, you're going to see that the SPX back here when this was taken was trading around 1988. So the point is, though, you can sell these things way out of the money and collect a nice credit. So here you can see you have what I call kind of open prairie up here. So this was selling short the 2045 call, buying the 2050. So this is a $5 wide spread, so that's $500. Now in this example, we brought in a $100 credit, so that goes straight in your bank account, and the difference is you're at risk of $400, and that would be the margin you'd put up. Now this has a negative risk ratio, and that's because you're selling way up here and you're starting this trade out with a high probability of winning, in this example around 80% based on 1 standard deviation. So you're not going to get that huge return, but you're going to get a nice return, and if you keep that $100, if it expires down here below that short strike, that's a 25% return, and the only capital that you put up here is your margin. So that's an example of a bear call credit spread. So that's if you think the market is going to go sideways to down. That's the other great thing. It doesn't have to go straight down. It can just go sideways, or it could even go up and you still make money. So that's the beauty of it. Now the next one is a bull put credit spread, and this is best to use when you think the market's going to go up. So in this example, in this strategy, you're selling a put while simultaneously buying another put with a lower strike and in the same month. So again, you could just sell naked puts, but you have a lot of different risk factors involved versus doing it this way where you cap your risk. And in this example, you're selling a bull put credit spread, so you're bullish here, and this is a win, and it's trading right here at $207. So you're you're bullish. You think it's going to go up, so you could just buy calls or you could buy the stock. But instead, you decide to sell an out-of-the-money bull put credit spread way down here, about 1 standard deviation out of the money from where it was trading right here. So this was selling a 187 put, and then below it buying the 182. Again, it's a $5 wide spread or $500. So you bring in a 130 credit, goes straight to your bank account. So the difference is you're at risk. If you do nothing at all to adjust or hedge this thing, the most you would lose if this went straight down would be 370. Now that's also the margin you put up per spread, so that's all you'd have to put up. And as long as, in this example, win stays above that short strike right there, the red line, you keep the $130, and that's a 35% return on your capital. So these are great ways to bring in income, profit, and these are also, as you're going to see, these are great ways to hedge another core option position you might have. So that's an example of the bull put credit spread. Now when you combine the two together, that's what we call the iron condor. So when you combine a bear call credit spread with a bull put credit spread, and you're looking for price to kind of go in between the two short strikes, so let's say you sold up here a bear call credit spread, and as long as the price of your underlying stays inside of these two spreads, you make a profit. So that's basically what an iron condor is. It's just the bear call credit spread combined with a bull put credit spread. So those are great ways to also get in even more credit. Now, step 5 then comes down to direction. And again, in trading, my trading view and formula is basically direction and then using options for your risk. So what I use, I have a directional trading model that I use, but one major component of this directional trading model that I like to use is a cycle reversal indicator. So I'm going to show you how that works and then how we incorporate that indicator with credit spreads and all that. So the first thing is just to kind of get an idea, what is a reversal? So this is basically what the indicator shows us. It's based on relative strength and some other things we put into the indicator, but what it does is it tells us when we've got a reversal. Okay, so it's a 2 studies. You've got the lower study and the upper study. So you can see down here, this is where the actual signal happened, and you can see overbought, oversold. So when we are coming from a position of overbought, like in this example, it's a great place to look at potentially selling bear call credit spreads. So today, we've been getting these reversal signals on the RUT, RUT, which is the Russell 2000 index, which are great for credit spreads. So based on this reversal, it doesn't have to roll over and collapse to make money. All you have to do is potentially you just sell it out of the money bear call credit spread up here, collect your premium, and as long as it just kind of churns sideways, you're going to make money. So that's what I like to use as this reversal indicator for these types of setups to start with. Here's some other examples. Here was on QQQ. You can see, again, if you look here at the reversal, you can see that here's one, here's another one. So these are kind of spikes and then they roll over. But look at this. So if you're selling out of the money bear call credit spreads here, even if it doesn't have to go straight down, it just has to churn, you're going to make money. Here you do the same, makes money. Here you do the same, and it's going to make money. So that's what we're looking for, and you can do it then to the downside. Here's a reversal up, sell a bull put credit spread below. So first off, that gives me a good directional signal, and then I put on the trade, and I've got a really high probability of that making money. Here's another example of Apple. So we have a reversal signal here, 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 and then we've got these reversal signals at the bottom to go long. So it really makes for a good kind of a alignment of giving you a good opportunity to take advantage of the credit spreads and time decay. Now let's take a look here at a bear call credit spread. So this is an example on the NASDAQ 100 using this index. So they're great for credit spreads. So I like the NDX, RUT, SPX. So here's an example, and here's that reversal signal. And this was on NDX. So this came like on the 18th. And NDX was trading right here at 59.90. So directionally we were looking at, okay, well, we don't have to have this thing collapse. All we need to do is have NDX just go sideways, and that would be great. Now if it goes down, that'll be even better. So first we have a directional sell signal here for out of the money bear call credit spreads. That was at 59.90. So we went up to about close to 1 standard deviation and sold the 60.80 short, bought the 60.90, so that's the short bear call credit spread. Let's take a look at the risk profile on that, and you can see here it was selling the 680, long the 690. Now this was done at about a 17 delta on the short side, so that gave us about a 78% probability of this being a winning trade going in based on 1 standard deviation out of the money. So the max potential profit was the credit received here of 260. The max at risk is the difference of 740. So if everything went wrong for you and you didn't adjust or make any defense, which I always teach, then the maximum you'd lose is 740. But the theoretical potential profit then, if you kept that full credit of 260, that would be a 35% return on your at risk. And this was for a trade set up for 18 days to expiration. But this one actually turned out to be profitable a lot faster because the market actually did go down. So took this trade off just 3 days later when NDX actually pulled back and was trading then at 59.35. Went ahead and closed it out just to reduce, not have that risk. So closed it out right here. This is the risk profile that you can see. So closed it out when it's trading at 59.35. So the credit spread, it went from 260 credit and it dropped down to $1.15. So bought it back at $1.15. And that gives you a profit per spread of 145, which in this case is a 19.5% return over a 3-day period. So, on 3 contracts, that's a pretty nice little profit for 2 or 3 days. So that's just a typical bear call credit spread using that reversal signal. Now the other one is what we call the ninja credit spread, and this is basically creates a ratio butterfly, and this is kind of what that structure looks like. So in this trade, it's basically what it is a variation of a regular equal strike butterfly, but it adds an additional short vertical credit spread. So you basically end up with 2 in-the-money credit spreads, then protected by a debit spread, and it really offers a very fantastic low-defined risk directional strategy, which usually gives you a really big positive risk ratio return. So let's take a look at an example on this. This is on Apple. And again, first starting off with direction, we had a reversal on Apple, and then it started pulling back. So I like to use Fibonacci for my targets and also look at unusual option activity. So in this trade example, we had really big unusual option activity at the $160 strike on the monthly options. So that, with the Fibonacci levels here, that 50% retracement 618 gave us a good target zone down here to 160. So for this trade setup, we set up a ratio called Butterfly for super cheap and had a really great potential return. So it was trading at 159. We were targeting 160. So basically what it is to break it down, the spread, this was buying the 157.5, selling the 160, okay, and that's a long call debit spread, and then incorporating 2 bear call credit spreads with that spread. So that creates the ratio butterfly. So you can see here you're short 2 of the bear call credit spreads versus being long 1 call debit spread. So it basically starts out as a butterfly, and then we sell another bear call credit spread to create that call ratio butterfly structure. So here's what that looked like. So the entry was set up on the 13th, and this was just going to the 15th, 2 days later into option expiration. So you don't have to have much price movement, and you don't have to have hardly any time. So this was set up with a $15 cost, okay? So the cost on this setup was 15 cents or $15. So that's the maximum at risk if the market goes down. Now, your maximum theoretical profit then on this setup was $235. The risk if it went up was $265, but with the huge unusual option activity at 160, there's very low probability of that happening because it was going to go out usually in pin close to that huge option activity. So based on your downside risk, which would be the $15 debit, the potential theoretical profit if you made $235 on this is 1,566% return on your downside risk of 15. The upside risk is 235 would be your 265 your potential loss. So that would give you a 89% return. Now this trade actually ended up making 176 per spread. So that return on your downside risk of that $15 was 1173, and the upside was 66, and that was over a 2-day period. So here's what it looks like, and it takes advantage again of implied volatility, collapse, and theta, accelerated theta decay. So basically this is made up of a butterfly like this. So the butterfly on the 160 butterfly, when it was set up on the 13th, that cost, that portion of this spread cost $70 debit, okay? Now on the 15th, that went out right here. You can see 160, it went out at 160. So that part of the trade made 175. Now the other part was down here selling a bear call credit spread, the 160, 162. So you incorporate that into it. So then you've got that element. And so that one also went out almost max profit. So that was selling the 160, 62 bear call credit spread. So that made $53. And so that structure then is this is what it looks like, the risk profile. So combining the butterfly with that additional bear call credit spread, the butterfly made 175, the bear call credit spread 53. So the maximum on this was 228 per option spread, which is a huge return. Now this was the actual setup, so we didn't make quite the max, but it was going out here, right here where that arrow is at 159.93. So this went from a $15 debit right here to $191 debit. So there's your $176 per spread profit, which is a huge return when you look at that $15 cost or at risk. So this is one of my favorites, and don't have a lot of time here tonight to really go through it, but if you'd like to learn more, I've got a fantastic course here for you. Plus, I'm going to throw in my cycle reversal indicator. This is a software that you can upload to your trading platform, and I'm going to throw that in as part of the package tonight just for anybody that signs up here. So it's a 5 bonus package, total value $985, and if you use this link here tonight, you can get it for just $97, and you'll get the indicator with instructions on how to use it, upload it, and everything. So let's go through the package. And so you're going to get this on-demand recorded course. I did this about a month back, so it's a 5-hour plus course, very, very detailed, in-depth course on selling options for income, profits, and hedging. I couldn't even get into the hedging part tonight, but it's a 5-hour plus course, okay, broken down in 30-minute modules. You also get the 389-page PowerPoint, so my courses are very, very detailed. So you get that, plus I'm going to throw in the cycle reversal indicator. This is a brand new indicator that I use. So I don't even have it on the website, but this will be $297 once I do get it up. We're going to do also then a follow-up live coaching Q&A, which will be in about 2 weeks. So that's a nice value there. And then I'm going to give you my option strategy manifesto, Greek power tool guide, and for anybody that's never been a member to my trading club, you get a free month in the trading club. And if you decide to say it's $97, but I think this is a super great value, and the cycle reversal indicator is going to be a great one for you to have, and you can use that for any of your trading, and you'll get it for Thinkorswim, TradeStation. You can have it for one or both. Just let us know which one you want, or both if you want. So this will take you through the course. You'll go through the Greeks that are really vital to this. Then within the course, we start out why use the credit spreads to create these low, high probability trades. We'll review how you use the cycle reversal indicator for these types of trades. And then how, why, and when to use the ninja ratio butterfly. What are the advantages of that ratio butterfly? And then how to use the various indexes, like using the SPX, RUT, NDX. When do you get into these trades? Should you get in 5 days, 10 days, 20 days out? So go through that. Then how and when to use credit spreads and the butterfly spread for your hedging. So this is a big part. If you're not hedging your positions or knowing how to hedge, you're going to eventually really get hurt. So you want to be able to do this, and this course teaches you a really quick way to hedge. And then I also teach you 6 defensive strategies for these credit spreads. And one of my I love this strategy, it's the condor defense. So I teach you that. Position sizing, step-by-step guide for setting things up, plus a great trading library. So just a huge amount of good stuff here. So, use this tonight, powercycletrading.com/hello, and you'll get the course, the bonus live follow-up Q&A, the training manual, 389-page training manual. You'll get my bonus surprise. This is a surprise. I haven't really ever given this away. So this is a cycle reversal indicator, and it comes in at two studies. So you've got the upper and lower study, and it'll give you, it's based on relative strength, and so it's going to measure overbought, oversold, and then give you a reversal signal. And you'll see on the upper study, when you get the reversal signal, you'll have these arrows pop up, okay, or pop up here. So it'll actually give you the signal of a reversal visually, and then the lower study shows you how that comes about. So you get that down arrow, up arrow, and these you can use for swing trades, day trades, spread trades, all this, and it's also going to be taught to you in the course. So that's the reversal indicator here, reversal indicator there. So it's a really great tool for your trading. Then you'll get the option 15 strategy guide here, 15 of my favorite strategies, what the risk profile, what they are, how they're used. And then you'll get this. These are for your printout to put on your desktop, and then you'll get my Greek power tool guide here that you can put on your desktop. What is delta, theta, gamma. So, you have a quick reference guide. And then if you've never been a trading club member, a trial membership to my club, and we have a trading room each and every day, do nightly videos, weekly Q&As, monthly award points, and discounts on all my trading tools and everything that I have. So great package just for you guys here and gals tonight. So hopefully you'll take advantage of it, and it won't be available after tonight. Thank you.